Ladies and gentlemen, welcome. Thank you very much for coming out to see me today. A lot of you may not know who I am. I'll give you a brief introduction, but I have a very special presentation for you today. And I want to let you know that the last time I was at this event was nearly 10 years ago. And the show has asked me to come back every single year, but I declined because I really like to do these shows when I have a very serious message to deliver. Now, a little more than 10 years ago, I had a very special message to deliver, and I traveled the world delivering that single message. Today, I have a new message to deliver to the trading and investment community, and I'm going to share that message with you today. Now, for those of you who do not know who I am, my name is Oliver Velez. I have been a professional trader for the last 33 years. I've had a successful career on Wall Street, and today run one of the largest trading organizations in the world. My website is olivervelez.com, where you can not only learn about me, my history, but also get information on my trading organization and what we do with traders around the globe. I have been featured in virtually every financial magazine, have appeared on virtually every single financial show over the last 3 decades. Ranked #1 by Barron's, rated one of the top traders in the world in 2009. 5 international best-selling books on the topic of trading the markets for a living in 5 different languages all over the world. About 10 years ago, I showed up at this event, and this was my trading team. I had 2,400 equity traders around the globe, 950 Forex traders, and 420 traders that focused predominantly on wealth. This made me one of the largest trading organizations in the trading space. Today, those numbers look like this. Nearly 8,500 equity traders, 2,200 Forex traders, and a little less than 800 traders that focus on producing wealth via the markets. The presentation I'm about to give you can be obtained by you absolutely free, wealth@ifundtraders.com, and at the end of this presentation, you might find it worthy to grab a copy. Now, I dug up this presentation from about 10 years ago. I dug up this presentation that I delivered at this event about 10 years ago to show you what was going on back then and the message that I had for traders throughout the world, investors throughout the world at that time. My message was, you should never sell. Don't you dare sell. Now this is from 2010. It was my view back in 2010 that we were in the beginning phase of one of the most unprecedented bull market runs in financial history. And I traveled the world delivering the message that you should bet virtually everything you have. And I explained why. And I explained why the message was to never sell. Now, that's a little facetious. There are times to sell, but you don't listen unless there's some shock value. So I included the word never, never sell. Now, I explained this reason because the markets met my specific wealth market criteria, which is made up of several items. #1, wealth markets run at a 45-degree angle the vast majority of the time. This is your wealth trend. There are different types of trends. The 3 main trends, as we know in the market, is up, down, sideways. However, there are a variety of ups, downs, and sideways. So out of all the up moves, the 45-degree angle move will typically run the longest. It was my view 10 years ago that we had this 45-degree angle trend going on in the markets, and that meant that we were going to have an extended run to the upside and that you should never sell. This 45-degree angle must be mostly comprised of small little bars or small monthly periods. So if every month is one bar, you need the vast majority of the month's ranges to be little, to be small, not big ranges, but small ranges. So we needed a 45-degree angle, which we had. We wanted the majority of the individual bars in the market to be small. We need a variety of single down bars or red bars. So not many 2 or 3 red bars in a row, but one red bar followed by a series of greens. Another red bar followed by a series of greens. Now, very little contact with the market's 20-period moving average. So let me show you a picture of where we were in the markets when I did this presentation the last time I was here. I want you to note that this part of the market, the 45-degree angle-like movement to the upside, I want you to note that the red moving average there is the 20-period simple moving average. I want you to note that there's very little contact that the stock makes with the 20-period moving average. I want you to also note that the vast majority of the individual bars are small bars. They're not very long or elongated. I want you to also note that you don't have many multiple red bars in a row. You get one red bar followed by green, another red bar followed by green, a single red bar followed by a series of green. You don't get many multiple red bars together. Now, when you put all of this together, the 45-degree angle, the small like bars, the series of single red bars, not many double and triple red bars together, and the little to no contact with the 20-period moving average, you have a market scenario that should continue for a relatively long period of time. And my message about 10 years ago was, we're about to enter into one of the most unprecedented bull markets in history. This is where the Dow was, 12,700. This is where the NASDAQ was. Note that same criteria, 45-degree angle trend. Little to no contact with the 20-period moving average. Note the little, tiny, small nature of the bars. See, not big, giant, wide bars like this, but made up of little tiny bars clustered together. Notice that there are not many multiple red bars in a row like this part, but one red bar, one red bar, one red bar, one red bar, followed by series of greens. NASDAQ, 2,500. S&P 500, notice the same type trend. 45-degree angle, little to no contact with the 20, smallish like bars, not many multiple red bars in a row. This is when you buy and you sit and do absolutely nothing for a very long time. Now, what were the results? What did my traders experience following this advice? As we know, Dow was at 12.7. This is where we are today, 29,206. Now, this was my last talk here. This is my current talk today. What do you think my message? My message here was you better buy and never sell. Now, My message today to you here, what do you think it is? Don't you ever, for the rest of your life, I'm being facetious, but don't ever buy again. That's my message. Now, I want you to take a look at my last talk here. I'm saying never sell. I'm saying never buy. Look at the difference. Look at the circle, my last talk, and look at now. Let's take a look at the NASDAQ. My last talk, NASDAQ 2500, NASDAQ now. Look at the last talk. My message was to never sell. My message today is to never buy again. Look at the difference. I want you to note the difference, at least mentally right now. We're going to talk about this. Here's the S&P, 1300. Here was the last talk. Never sell. Message today, never buy again. Now, look at the difference. I don't want to bore you with this, but here's just a bunch of Oliver's changed my life forever. Trading style is brilliant, amazing. All right? iFund Traders Program, amazing. Okay, here are 65%, 6 months, 32% in 4 months, 145% this year, 2010, 159% real, live individuals that followed what I told them to do during this last 10-year period. But check this out, weekly gains by traders. My new message today, don't you dare buy never again. And here's why. I want you to take a look at the Dow, this Dow chart. I want you to look at three things. You're going to look at the chart of the Dow itself, the price bars. You're going to grab the 20-period moving average, which is this blue line, and you're going to grab the 200-period moving average. And we're going to look at these three items together. Now, during my last talk, I want you to note the Dow, the 20, and the 200, and the locations of those in relationship to each other. Now, I want you to go to this, where we are today. I want you to grab the Dow, now grab the 20, now grab the 200, and I want you to look at those three items in relationship to each other and tell me what you see as the difference. What are the different states? On the left, we've got the three what? Together, narrow. So there are two states in the market. The market vacillates between a narrow state when all three are together and a wide state. Narrow, wide. The market's like a breathing mechanism. It inhales, narrow, and then it exhales, expands. So it goes from a narrow state to an expansion state, back to a narrow state to an expansion state. And those are the only two major movements that markets repeat over and over and over again. And every single cycle, millions of individuals get these two movements wrong. They get these two vacillating movements absolutely wrong. Now, it's clear that the best times, the best opportunities for you are going to come when the market's in a narrow state. The worst opportunities from the buy side are after the market has expanded and your three items are apart. Now, Let's go to the NASDAQ, the same. This was my last talk. The three items are tight together. We have gone through multiple years that have now separated the three items apart. The worst possible time to be a buyer. And if it's the worst time to be a buyer, then naturally it's the best time to be a what? A seller. And a big one. Now, it is my belief that this market has been primarily driven by indiscriminate buying, which means that it's not intelligent buying, that it is not thoughtful buying. It is not the buying of a Warren Buffett. It's the automatic buying of index funds. You see, an index fund receives money, and by its own charter, it has to put the money into the stock market, into the stocks that represent the index. So if you have an S&P 500 index fund, that fund must buy the 500 stocks in the S&P every time it gets money. And so the number one type of fund in 401k plans across America, 90+% of the money goes into what kind of fund you think? An index fund. And so every week, these funds receive millions of dollars from corporate employees. By their own charter, every week they've got to buy. They've got to take the money received and buy. They've got to take the money received and buy. At some point, this is going to stop. At some point, it might take one event. One event is going to change this cycle. And so individuals all over will say, whoa, wait a minute, I just lost $72,000 in my 401k plan in 1 week. Whoa. Let me stop my inflows into my 401k plan right now, or let me stop my inflows into this index fund and move it out into a money market fund. If this starts to happen in mass, where index funds have to make redemptions, have to sell to put the money, pull the money out and put it into someone's money market fund, we're going to see the whole reversal of this happen. And let me tell you something, every trend reverses. Every single one. So one of the most important things is to know what state is your market in. Is it in the narrow state, and is it in the wide state? We know our current state of the market. S&P 500, this is where we were. This is where we are now. The three items are spread apart. Now, here's my space concept. I want you to be very aware of this. This is my space concept. Three items wide apart. Let's go back. This is the NASDAQ now, the three items separated apart. These are the three items together, okay? Now, let's go back to the year 2000. Do you remember that year? Do you remember the internet craze? All right. Notice back in the mid-1990s, notice the three items together. Notice at the peak of the market in 2000, notice the wide separation between your two things. Here's your 200, here's your 20, and there's your stock. We went from narrow to wide and all the way back to narrow. This will repeat forever. This is what markets do. They vacillate between narrow states and wide states. If you get the two states correctly, you can become very wealthy. It starts by knowing what state you're in. So that now, anyone who's thinking about buying in a wide state will ultimately get hurt very seriously. Another way of looking at this is look at the narrow state box and look at the wide state box. Back to narrow. Another way of looking at this is through space. So I teach a concept called the dual space concept. All right? Space between the 200 and the 20, and the second layer of space between the 20-period moving average and your peak. Now, normally, when that space becomes relatively equal, you're very close. So look at the measurement of the arrows. Fairly equal. Not perfect, but fairly equal. And when I see equal space between these three items, I know we're close. Now, if we take this concept and go to now, this was the 2000 collapse. Now, I want you to understand this collapse, we're almost 5,000 and we go to 800. Do you understand the significance of that? The percentage is huge. 5,000 to 800. We're talking 70, 75%, 80% decline. Now, we take this collapse, or this height looks nothing compared to this one now. Look at the crash of 2008. This is what brought the American financial system almost to its knees. This is nothing compared to this, and this is nothing compared to this. Now, I am telling you, I will be talking tomorrow at, I believe, 1:45 in the main exhibit hall about my #1 recommendation for this year. And I'm willing to bet, if you follow it, you're going to live to thank me. Take a look at all of your narrow states. Narrow state together. And what happened after? Narrow state together. This may not look like very much, but we go from basically 800 to over 2,000. That is a huge percentage move. It just doesn't look that big because of this and this. But we go back to a narrow state and now a wide state. Now, I want to point something out here. I want you to take a look at the 20-period moving average, the blue line, and the index itself. The reason why I focus predominantly on the NASDAQ is because the NASDAQ is the leading market. The NASDAQ is supporting everything. So you want to focus on what the NASDAQ, in particular, what the NASDAQ 100 is doing. This is going to lead the decline. And when this one starts to unravel, all of the other indices will unravel. So you want to focus on this one. Now take a look at the 20. I want you to note that every time I want you to look at the spaces between the index and the 20-period moving average. Notice how oftentimes the 20-period moving average is sort of like a springboard. So you touch the area of the 20, you spring off. We touch the area of the 20 and we spring off. We touch the area of the 20 and we spring off. Now look at the spaces when the average springs off the 20. I want you to look at the spaces. Look at the space between this spring off and the 20. Look at the spaces in between. 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 Now look at the space. You see something different? That the bounce off is wider than the whole history of the move to the upside. This is total exasperation. This is extreme. Here's one thing I want you to always know. You can get away from the 20. You can't stay away from the 20. You can get away from it, but you can't stay away from it. You can get away from the 20, you can't stay away from it. You can get away, can't stay away. Get away, you can't stay away. Get away, you can't stay away. Get away, what's next? Can't stay away. And the drop from around this 10,000 number to the 20 is pretty severe. But I believe it starts something far more severe than just coming back to the 20. I think we go through it. Just like here. The other thing, distance from the last major peak before a collapse, historical distance. You see, it's actually less concerning if this is here with no or very little space. But the historical space, the distance between the two potential peaks here is very significant. This time-driven space, if you will, my space concept, also leads to the severity of what potentially can happen. So, you have space in two forms. Vertical space vertically between the three items, and space horizontally between the two potential peaks. And it is this dual layer of space, vertical space, horizontal space, that adds to the severity of what potentially can happen. Vertical space, vertical space. This is the last moment you want to think about putting money in. In my opinion, there's only one thing to think about. What is that? Pulling money out. This is the time to do it. Now, your question's got to be also not only to protect what you might have in, but how can you profit from that? How can we turn what potentially can happen if we're ready for it? And you don't have to know when. That's the beauty. So many people assume that in order to play this game, you have to predict the future. No, you have to just read the now. So how do you know when this has started? When this event happens. This is the event I'm about to cover with you. When this happens, you know, oh boy, Oliver's right, it's now starting. So we wait for what I call the bear 180 to occur. You're going to use a monthly chart on the NASDAQ, right? You just pull up a monthly chart of the NASDAQ. You follow it month by month. When you get this scenario, when 1 month wipes out a solid green month, preferably 2. So preferably 1 month wipes out 2 solid green months, but all in one fell swoop. You get this scenario, I am telling you that what I've described here today has begun. And you're going to know as it develops, you're probably going to be saying to yourself, Oliver must be profiting very well. Oliver must be profiting very well. All right? So, what's the criteria? You need a solid month to the upside. The market must have this strong, solid month and a 180-degree wipeout. Now, what this means, this month, you can't have this kind of monthly bar unless a lot of people have gone in. A lot of money has gone in to produce a bar like that. That's hundreds and hundreds and hundreds of millions of dollars. You can't produce a bar like that in the NASDAQ unless hundreds and hundreds and hundreds of millions of dollars have gone into the market to produce that bar. But the following month makes all of that money at a loss. Now, I want you to think about how you feel. You've gone into something thinking that the future is higher, and something all of a sudden slams your move and puts you totally in negative territory. But not just, see, there's something different about gradually becoming a loser. You can bear the gradual losing, but you can't bear the sudden shock. Boom! That's the one that rocks the market. This is not a trickling down. This is boom! And it is that event that sends shock waves through everyone who's gone here. So the people who bought here, the people who bought there, the people who bought throughout this whole bar turn to become sellers. As this move wipes out another green bar, it starts collecting the number of losers. So remember, the people who bought here are now losers here. And then as this bar grows, the number of losers grows. The number of losers become sellers. So the selling camp starts to grow. As the losers increase, the sellers increase. And this becomes a self-feeding phenomenon. That's what we're looking for. It's different if this red is broken up into little pieces. Even if it gets down here, but gradually so, that's not the same shock. That's not the bare 180, I'm telling you. This event must be in one fell swoop. Boom! And that shock sends the world into a frenzy. Now, you want this event to be where? I need you to tell me. If you've been listening to me, remember the two states, narrow and wide. You want this event where? Way up there in a wide state. You see, if this event is in the narrow state, it doesn't have the same significance. It's negative, but it doesn't have the same significance from a narrow state. This event, after wide, is like, oh my God. And all you have to do is simply once a month check the NASDAQ on a monthly chart. And when you get the scenario, and trust me, it's coming. Mark my words, it's coming. When you get this scenario, it's time to bet big on the downside. Do you see that scenario in the NASDAQ? This is going back to 2000. Do you see violence? I call those big red monthly bars violence to the downside. Do you see it? Remember, you need a solid month up and then a 180-degree wipeout of that solid month, anywhere from an extended state. Now, in truth, you have it here, You may not see it clearly, but this red dropped all the way to that low, wiping out not only the vast majority of this green bar, but all of this green bar and all of that green bar. So this shock to the system. Now we had a little bounce here, which is typical, and then the real decline began, starting off with this event. Solid green, red wipeout. Solid green, red wipeout. That's the event you're looking for. Any solid green. Now, what, I know you know this, but entertain me a bit. When this bar moved to the high, at the high, what color is it? It's green. And what kind of green? Isn't it that kind of green? You see it in your mind? At the high, at this 4,000 mark, you got a solid green bar. Inside of the same bar, the green disappears. So, look, at this point, this bar is similar to that one, solid green. But then it loses 20% of its green, then a third of its green, then half of its green, then 3/4 of its green. So inside of this bar, isn't that this? So look, imagine instead of the red movement down happening the next bar, what if this green began to fall inside of itself and drop here? It's the same event, just faster inside of one bar. So you can have one monthly bar that goes up, green, and in the same month, lose its green. I want you being aware of that scenario too. So you can have green up, and then the next month, eliminate the green. That's this scenario, all right? The green, and then the next month eliminates the green. But you can also have the same month, green, eliminate its own green. And if this happens from a wide state, you want to say, go. Start betting to the downside. The vast majority of the green has been wiped out here. And this is the major signal. The solid green, and the next month wipes out the green. These are two shocking events that when they happen from this extended state, there is an 87% accuracy rate. 87% accuracy rate that you're going to have serious follow through to the downside. Now, there are systems that exist in my industry that have a 38% accuracy rate, and they make these systems make millions of dollars. 38% accuracy rate. This has an 87% accuracy rate. Come see me tomorrow at 1:45. I want to talk to you specifically about how I and how you should take advantage of this. I want to let you know that I've been an extraordinarily profitable, successful trader over the last 33 years, breaking several trading records, internationally known, and I speak all over the world on the topic of markets. I've consulted with some of the biggest exchanges throughout the world on the topic of liquidity and professional institutional trading. And I want you to know that throughout my 33 years, the two biggest periods of wealth increase personally have been this period and actually this one, as small as it looks. The 2008 collapse and the bursting of the internet bubble collapse. Now, I have to admit that my last message here to get heavily in and never sell, a little facetious, but you understand, all right? This period over the last 2 years has actually surpassed my successful periods to the downside here. So this is now the most profitable period for me and my traders. Just over the last 2 years, it is surpassed. But I'm willing to bet that the biggest period of my life, after 33 years, the biggest one is coming now. This is going to be, in my opinion, one of the severest collapses the market has experienced in its history. Ladies and gentlemen, thank you very much.